So I'm here today to talk about the qualified business income deduction. And what is this? This is in the news a lot lately. It's been all over the place. There's a lot of misinformation out there. And I'm here to hopefully shed some light on what this actually is and how it may apply to you. So we've decided to make a whole section of this presentation as sort of a deeper dive into this, because I think a lot of people in this room, there's a lot of small business owners, people who work for small businesses, and this will have an impact in what you do for this year, potential planning opportunities, and going forward. So this is called a bunch of different things. It's been called the self-employed deduction, the small business deduction, all sorts of other things. This is officially titled the qualified business income deduction. And I think before we go into it, it's important to understand what this actually is designed to do. I don't know how I'm feeling about this thing. So what is this designed to do? So for the past 30 years or so, it has been better for small businesses to operate in a pass-through form. Okay, it's always been better. S-corp, partnership, generally for any taxpayer, that is a better way to operate. When they started talking about making all these changes this time around, they were talking about cutting the corporate tax rate. And they did, as Bob talked about, down to 21%. So when you cut the corporate tax rate down to 21%, in order to equalize what you have for the individuals and the small businesses, you need to do something to make it so that they're still in a good position, right? So generally it was 10 percentage points better to be in a pass-through prior to this new law. When you cut the corporate tax rate 14 points, that changes everything immediately. So this deduction was put into place to equate that from what it used to be. So that's the goal of what this is, right? It's supposed to equalize what happened after the new act is in place compared to what it was before that. It's supposed to stop companies from reorganizing into corporations and things like that. So how is this going to work? Generally, you're going to get a deduction for the lesser of these things. Your combined qualified business income amount, I will explain what that is, or 20% of the taxable income minus the capital gain. That second point, I'm not going to touch on that too much. What that is if you have someone with significant capital gain, that is already being taxed at a preferential rate. And so offering a deduction for that would sort of be double dipping for the taxpayer. I'm not going to go into that any further, but that's why that's there. So what is a pass-through? I don't think any of this is new for anyone in this audience, what a pass-through is. These are the kind of businesses that can make use of this new deduction. So your Schedule C sole proprietor, your Schedule E rental businesses, your shareholders of your S corporations, partners in partnerships, anything that we traditionally think of as a pass-through is a pass-through in this context here. Note that trusts and estates that also receive pass-through income will get this deduction as well, not just individuals. So I think how we're going to attack this is I'm going to define all these different things, and I'm going to try not to put you to sleep because I know it can get pretty boring. We're going to get kind of technical. I'm going to show a bunch of examples. You're going to see how it may impact you and your business, and how the type of entity that you have your business structured in may or may not be the most tax-efficient way to do it, which in the past there wasn't much of a question. Now there is a big difference, and I will show you that. So, first step, what is combined qualified business income? Okay. This top part right here, this 20%, is I think what was in the news mostly. So 20% of your qualified business income. Or, so it's the lesser of that number, or, and we're starting to see a bunch of limitations. I'm going to go through a couple of different limitations here. This is one of them. I like to call this the wages limit. You're going to be able to take the lesser of, again, 20% of your total income, or the greater of these two things right here. So your business wages paid to your employees, or 25% of those wages plus 2.5% of something we'll get into the qualified property. Also part of this are the REIT dividends and the publicly traded partnership income. I'm going to kind of ignore those because they're just going to come forward for you when you get your paperwork. If you are invested in REITs or publicly traded partnerships, you will be able to make use of this deduction, but I'm not going to spend any more time on that. So now we're sort of narrowing this down even further. What is qualified business income? It seems like a pretty straightforward concept. It is all of your business income. So basically, any business net income you have is going to be considered qualified business income. It specifically does not include these things. So interest, dividends, capital gains, investment income is not going to be considered part of this qualified business income. Down here, we talk about W-2 wages paid to the shareholder and the guaranteed payments paid to partners in a partnership. That's a little bit of a gray area. I will get into some uncertainties in a little bit. There are a lot of uncertainties in this law as to what is officially going to end up being, gospel. As Bob talked about, there's no regulations yet. There's very few notices or anything of that sort. So we're going to learn a lot more about this as the year goes on. But the goal of this is to hopefully shed some light on, again, what you should be looking at for yourself. So like I said, there are a couple different limitations of this law, of this deduction, right? There's wages, and we're going to get to something shortly called the specified excluded businesses. But this deduction will be limited to the greater of 50% of the wages paid. Again, we sort of touched on this already. Or 25% of the wages paid plus 2.5% of the unadjusted basis of the property. So you can see here that this is really targeting businesses that actually have employees. So if you have a business, you have a small business, maybe you have a pretty good thing going, you don't have a lot of employees, maybe you don't have any employees. This may be a problem for you, this deduction. You may not be able to make much use of it at all. But, as we'll see in a little bit, for example, the S corporation, you're required to pay yourself a reasonable compensation as a salary out of an S corporation. So doing that will give your company wages that you'll be able to make use of with this deduction. So we will see some examples a little later on about how, in some cases, the S corporation may be a better result strictly because of that right there, the requirement and the ability to pay wages to yourself as the owner. I wanted to throw in here real quick a definition of what is qualified property. This is basically tangible, depreciable business property. And this was really thrown in at the very end of the law. This whole little section right here was thrown in at the end of the legislation in order to appease real estate businesses. So sometimes large real estate companies, they may not have a ton of employees, but they have a lot of capital investment in real estate or other types of, you could have equipment, you could have anything. This allows those large real estate businesses to potentially make use of this deduction through the qualified property rule. Everyone's still with me? Any questions so far? I must be doing a great job then, right? So this is the second limitation I referred to. So first I talked about the wages limits. Now there's a second limit that we have to think about here, and that is the excluded specified service businesses. So regardless of what I just talked about on that last slide, right, those wages limits, if you are in a certain range of businesses right here, if you're in one of these businesses, you are not going to be able to make use of this deduction. And these are very specific. They're very specifically named in the code right here. So healthcare, law, accounting, actuarial science, performing arts, consulting, athletics, financial, brokerage. Those are all named in the code as excluded businesses for the purposes of this deduction. Where we get some uncertainty is this additional little description right here. So also excluded from taking this deduction is any business where the principal asset is the reputation or skill of one or more of its employees. So if you think about that, architects and engineers were specifically excluded from this list. If you're an architecture firm and your principal asset is your own ability to be an architect, does that run afoul of this rule? Because you're not named in this law. You're okay on this side, but are you really okay? That's an uncertainty that's going to have to be addressed through the regs. We don't have an answer on that at this point in time, but this is in the law. And now we get to throw out everything that I've just talked about for people who don't make enough money, according to the IRS. So I talked about the wages limits, talked about the business limits. If your taxable income is below these amounts, $315,000 jointly, $157,500 for everyone else, basically everything I just said doesn't apply to you. So you can kind of forget everything I just said about all those different limits. You can be in any industry you want. You don't have to pay wages. You can do whatever, and that you'll be able to take this deduction. When you are over these amounts, there's a phase-out range down here. When you are over these amounts, that's when you run into all those different limitations. I will go through some examples so I can kind of illustrate this. I understand there's a lot of information here kind of coming at you rapid fire. One thing you may notice on this is that it's related to taxable income. And that's not the taxable income of the business. That's the taxable income of the individual. So if you are in a business, and maybe you have a couple of business partners, a couple of you, and some of you are below the $315,000 limit, and some of you are above the $315,000 limit, you may have very different ways that you want to structure this business. It introduces a competing interest that you may not have had previously. And I think it also raises a bunch of questions of volatile businesses. Businesses that make a lot of money one year, don't make a lot of money the next year. I will show a little more on one of my illustrations, hopefully how that will have an impact. Any questions up to this point? Again, I know I'm throwing a lot of information. But basically, you can remember that if you're below this dollar amount, if you're in this audience right now, and you're thinking you're going to qualify for, and you're below this dollar amount, you will be okay. I've hinted at a couple of uncertainties so far. There's a definition. There's a question of what is the definition of a trade or business, for example. I'm not going to try to define that. It's a very vague definition in the tax code. It's going to have a big difference on here. Is there a question of whether you're engaged in a trade or business? If there is, you're going to have a question of whether you can take this deduction. Real estate. There's questions of whether real estate is a business, for example. There's also a question of the treatment of S-Corp W-2 wages and partner guaranteed payments. some practitioners are reading the law as they believe the intent of the law was. So they are reading into sort of unwritten parts of the law, expecting that there will be regulations addressed that will address those different uncertainties and sort of make a lot of the examples I'm about to show you sort of non-existent or irrelevant. But for right now, we're going basically strictly with what we have in the code, which is code section 199A. So I'm about to go into some examples very shortly here. Again, that's only based on a reading of the law as it currently sits. Any changes to come, and there will be some regulations. There'll be plenty of them, I'm sure. Plenty of court cases. There may be people in this room, not sure if who may be in the oil and gas industry. We believe, based on the reading of the law, that oil and gas businesses should qualify for this deduction. There is a very specific code section that I'm not going to get into that is referenced here, and it does not reference any oil and gas depletion-related business activities. So as far as you can tell, these should be able to qualify for this deduction if you are in the oil and gas industry. And one other thing I wanted to throw in at the end, we touched on this in the very beginning, publicly traded partnership income is eligible for this deduction. Many oil and gas investments are structured as publicly traded partnerships. So that will help for you as well. We're going to go through 4 examples now of how this calculation is going to work. And it's really just an illustrative exercise so you can see how different types of entities will have different results. So you may currently operate as a partnership. Maybe it would be best if you operated as an S-Corp. You may be as an S-Corp. Maybe it would be best if you operated as a partnership. There's not going to have answers. You're not going to be able to answer that question right here with this fact pattern, but it's supposed to illustrate that there are differences now. So here's our example. Married filing jointly, no other taxable income, which is important because, again, we're looking at the taxable income of everyone. Manufacturing business, so it's not a specified business industry. $100,000 of equipment, some equipment in the shop, some employees. Your net income after all that is $1 million. So that's our owner's income is $1 million. So it's very well for himself. Sole proprietorship, you can't pay yourself W-2. You don't take wages out of your own Schedule C. But if you're an S corporation, you have to pay yourself a reasonable compensation. And then we'll throw in this last example. We'll assume he has some additional partners. They're taking guaranteed payments. His guaranteed payment is that same $200,000. So he's effectively paying himself $200,000 of salary either way. What happens when we look at the numbers? And hopefully everyone can read this. If not, I'll go through it. So the top line, your income, that's the same no matter what. You start off at the same place, $1 million, all across the board. For the S corporation and the partnership, though, you're paying yourself compensation. The S corp, he's paying himself $200,000 of wages. Partnership, $200,000 guaranteed payment. So the actual qualified business income in these two contexts is $800,000. So in the sole proprietorship, nothing happened. He's still got $1 million. First thing you're going to do is you're going to figure out what is 20% of that number. Still, at this point, the sole proprietorship is the better result. Because at this point, you're looking $200,000 in the sole proprietorship, $160,000 and $160,000 in the other two. But because he's over those income limits, we now have to look at the actual wages paid by the business as well. So we can sort of ignore this depreciable basis line. They don't have enough depreciable equipment to really make this much of a factor, so we're going to ignore that. What you're really looking for is the lesser of these two numbers. The lesser of these two is what you are going to be able to deduct on your tax return. So in the sole proprietorship and the partnership, your wages are $300, so half of that, $150. But in the S corporation, because you paid yourself a salary because you had to, you now have $500,000 of wages. So your 50% limit is higher in that context. Again, we're looking at the smaller of these two lines right here. So we can see that in the sole proprietorship and the partnership, it's 150. But the S Corp, you're now able to take 160. So think about that. Exact same business, same fact pattern, everything else exactly the same. And simply being in an S corporation rather than a partnership or operating a sole proprietorship gives you the best result. Sort of mind-blowing. I don't know if the law was intended to be written this way, but this is what we have as of right now. So in a case like this, this is your situation, you may want to consider becoming an S corporation. That's sort of the planning point here. So we're going to keep going. A similar example, only this time, same general fact pattern. Manufacturing business, no other income, total wages still 300. Now you're making 150. You're taking home 150 at the end of the day. Sole proprietorship, again, you're not going to pay yourself. You are required to pay yourself a salary out of the S corp. We'll say 70,000. Pick a number. Same thing with the partnership. You're paying yourself 70,000 as well. So now what happens? Well, your income's going to start the same, 150, yet again. You're going to take out some wages and guaranteed payments in these contexts over here. Your qualified business income is reduced. 20% of that number was simple math. 30,000 in the sole proprietorship, 16 for both the S corp and the partnership. But now your income is below that $315,000 threshold. So because your income is below that threshold, you can ignore the wages limits. Just kind of forget they're here. You don't have to pay any wages, and you'd be okay. So because we can ignore that, the sole proprietorship is now the better option. So I think this gets back to my point I was trying to talk about earlier of volatile businesses, right? If you have a business that's making $1 million one year, and you're making 150 the next year, and you're not really sure how it's going to go in the future, you have up years, you have down years, it's going to be pretty difficult to plan for this. It might not always be the same result every year for you. And again, I think that also builds on to if you have a bunch of other business partners, you may have different goals with this. So I think it is worth looking into considering how you are structured right now, considering if that's the best result for you. So I have two more examples. This case, we now have a law firm. So the business has a little bit of some computer equipment or whatever, some wages paid to employees. Our attorney now makes $1 million, very successful attorney. Doesn't pay wages to himself, has to pay a reasonable compensation out of the S corp, pays a guaranteed payment out of the partnership. So what happens here? Well, the answer is nothing happens because he's in the wrong line of work. So because his income is over that $415,000 threshold, it doesn't matter what he does in the business. He makes too much money. He's not going to get any deduction out of this. Kind of hurt himself by being in the wrong line of work, I guess. Well, he's still making $1 million, so he can't be too upset. Why didn't he get allowed the deduction? Specified service business, taxable income over $415,000. But what if his income was below that amount? Then those rules wouldn't apply, which is example 4. Same fact pattern, $150,000 of income. Instead of the $1 million that we had last time, now he's making $150,000. He's going to get that 20% deduction. So the sole proprietorship, this is the exact same table from example 2, because it doesn't matter what scenario you're in if you have the same fact pattern. It doesn't matter if you're a law firm or a manufacturing business if you're below those income limits. So it's, in this case, it's the best, again, to be in the sole proprietorship. So again, I'm just trying to really hammer that point home that it does matter what business entity you are in. One other little thing to throw in at the end here that I felt was important. All of this that I've talked about is only for income taxes. That deduction, by the way, will not be an itemized deduction. It's going to be a deduction, just a regular line item on your tax return, just in case that was unclear. Everything I've talked about addresses only income tax. But there are also self-employment tax concerns. So a sole proprietor and a partner in a partnership are generally going to have self-employment income. The S-corp will not. So the taxpayer is required to pay a reasonable compensation, which can be a very important thing in this context, but he's not going to have self-employment income. So there's more to think about than just that extra $10,000 deduction. You may be putting yourself into or taking yourself out of self-employment tax as well. So there's a bigger picture, a bigger overview that you have to think about in this sense. And I wanted to throw this last thing in as well. Losses. If you have losses, they are carried forward to future years, and they will offset the QBI in those later years as well. So if you have a loss one year, you make money the next year, you might not get the full 20% of that second year. You're going to get that amount minus your carryover loss times 20%.
And we did say earlier this was a complicated piece of legislation. This is, I think, one of the more complicated ones. But if you have any questions, we'll be happy to try and answer them. And if you want to just come up to us afterwards, we'll try to help you as well. We'll be around for a while. Any questions?
Bob, you envision this playing out similar to the 8903s as far as K1s
It is.
supplemental information
It is.
have to be conglomerated at that 40 level?
Yes.
Yeah, absolutely. I think what the question referred to is the fact that if you're invested in a partnership or an S corporation, they're going to have to provide certain data as far as the wages that the entity paid and also the depreciable equipment or assets that the entity has as well. That'll definitely need to be provided.
They have talked about that is absolutely going to be required at the corporate and partnership level. So when I talk about your share of W-2 wages, that is your individual pro rata share. So if you have a business and you have 10 shareholders, you got an S corp with 10 shareholders, and they each own 10%, whatever wages are paid by the entity, you're each going to be able to be allocated 10% of those wages, basically based on your pro rata share of the company. That's a good question. Now the K1s are going to have to report all that. They haven't come out and said yet if it's going to be extra boxes on the form or if it's just going to be a footnote attachment to the K1, but they are going to have to give all that information out.
I think that concludes the presentation, but we'll be around, and you're welcome to have a couple of drinks and a couple of hors d'oeuvres, hopefully. And I hope you enjoyed it. Thank you.